Europe's recent shift away from U.S. natural gas to Canadian energy supplies is sending shockwaves through the global energy market, posing significant questions about the future of U.S. exports and their economic ramifications. This dramatic change isn't just about gas. It's about a complete reconfiguration of energy alliances, market dynamics, and geopolitical power. The catalyst for this transformation can be traced back to the war in Ukraine, when Russia's gas supply to Europe was severely disrupted due to the EU's sanctions. Europe found itself in an unprecedented energy crisis. Initially, the US appeared as a reliable lifeline, sending large quantities of liquefied natural gas, LNG, to Europe, helping the region survive a particularly harsh winter. The US energy sector seemed to have saved the day. However, this relief came at a steep price. US gas prices were far higher than global market rates, causing European governments and businesses to realize they were paying a premium. The cost of US LNG was unsustainable, and further concerns grew about Washington's erratic trade policies. With each shift in administration came a new energy policy, creating an unreliable foundation for Europe's long-term energy security. The US began to be seen less as a stable ally and more as a strategic actor, using energy exports as a political tool. This, combined with the rising costs of LNG, pushed Europe to search for alternatives. Canada, with its abundance of natural resources, became an obvious choice. The country is rich in oil, gas, and critical minerals like lithium and cobalt, which are essential for the electric vehicle (EV) revolution that Europe is heavily investing in. What made Canada stand out wasn't just its abundant energy resources, but also its stable and predictable trade relations with Europe. Unlike the US, where policies shift dramatically with each new administration, Canada has maintained consistent, long-term cooperative economic ties with Europe. Adding to its appeal, Canada's commitment to clean energy, solar, wind, and hydroelectric power, aligns perfectly with Europe's green energy goals. While the US remains heavily dependent on fossil fuels, Canada is already transitioning to a more sustainable energy system, making it a far more attractive partner for the EU. This pivot to Canada isn't just a blow to US energy dominance. It's a significant economic setback. The EU was once the largest buyer of US liquefied natural gas, LNG, and with Europe turning to Canada, the US stands to lose billions of dollars in annual revenue. The US energy sector's reliance on foreign markets is now being called into question, and its influence over Europe is at risk. Beyond energy, this shift also impacts the US auto industry. Canada's ability to supply critical minerals for EV battery production further solidifies its role as a key partner in Europe's clean energy future. Meanwhile, the US's stringent environmental regulations, which hinder its ability to mine these essential materials, make it less competitive in this growing market. The geopolitical implications of this shift are profound. As Europe deepens its energy and economic ties with Canada, the US faces not only a loss of revenue, but also a decline in its strategic influence, signaling a broader realignment in global energy and trade dynamics. The US has long used energy exports as a tool to exert influence over its allies. If Europe can secure a reliable, politically neutral alternative in Canada, it weakens the US's position in global negotiations, reducing its leverage in international affairs. This shift could have cascading effects on US foreign policy, presenting Washington with a significant challenge in reclaiming its influence. As tensions between the US and Canada escalate, the two nations are now locked in a trade war that could reshape both North American and global economic landscapes. The US recently imposed tariffs on Canadian imports, including energy products, prompting Canada to retaliate with tariffs of its own. However, this trade war extends beyond consumer goods. It has a broader focus on energy. Canada is already pivoting its energy exports toward Asia, particularly China, to reduce its dependence on the US. The expansion of the Trans Mountain Pipeline, designed to boost oil exports to China, Japan, and South Korea, is a clear signal that Canada is diversifying its energy markets. This strategic move aims to minimize risks and seize greater economic opportunities. China, with its enormous energy demand, has already become a crucial partner for Canada's oil industry, and the two nations are forging stronger economic ties. If this trend continues, Canada could further reduce its reliance on the US, with profound implications for the global energy market. But what would happen if the US suddenly lost access to Canadian energy supplies? The consequences could be catastrophic. The US imports over 6 million barrels of oil per day, with nearly 67% of that coming from Canada. If Canada decided to cut off or reduce oil exports, gas prices in the US would skyrocket, particularly in the Midwest, where refineries depend heavily on Canadian heavy crude. This would not only drive up fuel costs, but also increase production expenses across industries, from transportation to food and consumer goods. The ripple effect would cause the price of nearly everything to rise, potentially plunging the US economy into a severe recession. This scenario underscores the delicate balance of energy interdependence and the high stakes involved in the shifting dynamics of global energy trade. US refineries are specifically designed to process heavy crude, and if they lose access to Canadian oil, many could face operational shutdowns, triggering a massive economic ripple effect. This potential energy crisis, however, could create opportunities for certain players. Big oil corporations like ExxonMobil and Chevron might seek to ramp up shale oil production, but this wouldn't happen overnight. The US would face significant challenges in replacing Canadian heavy crude, and even if shale production increases, it would require massive investment and could encounter strong environmental opposition. Meanwhile, OPEC, Russia, and China could seize this opportunity to further manipulate global oil prices and expand their influence over the energy market. This raises a critical question. How will the Trump administration faces a tough dilemma: continue the trade war with Canada or negotiate a new deal that benefits both countries? If the US maintains its tariffs on Canadian imports, Canada may retaliate by cutting off oil and electricity exports, leading to surging energy prices and destabilizing the US economy. Alternatively, the US could negotiate a new energy deal with Canada to stabilize relations and protect its interests. Another option is to increase domestic oil production to reduce reliance on Canada, but this approach comes with environmental and regulatory hurdles that could take years to overcome. Canada, however, isn't passively waiting for the US to make a move. In response to the tariffs, Canada has launched a boycott campaign, urging its citizens to support domestic goods over American imports. Provinces like Quebec and Nova Scotia have already removed American-made alcohol from store shelves as a direct act of resistance against US policies. This economic protest underscores Canada's determination to protect its sovereignty and stand up to US tariffs. The implications of this trade war extend far beyond energy and raw materials. It represents a broader struggle over economic influence, environmental priorities, and geopolitical power, with far-reaching consequences for both North America and the global economy. Major US manufacturers, particularly automakers like General Motors and Ford, heavily rely on Canadian raw materials for production. If the trade war continues, production costs are likely to rise, potentially pushing US manufacturing to the brink. Similarly, tech giants such as Apple and Tesla could face higher costs for components sourced from Canada, which may erode their competitive edge. Even smaller manufacturers dependent on Canadian raw materials might be forced to shut down or lay off workers due to escalating production costs. The US economy, already strained by inflation, could face further challenges if these trade tensions intensify. The stock market is likely to suffer as investors grow wary of the long-term impacts of a trade war with Canada. Additionally, the tourism industry could take a significant hit, as Canadian tourists are a major source of revenue for the US, particularly in states like Florida, California, and Texas. If Canadians reduce their travel and spending on American goods, the US could lose billions in annual revenue, further worsening economic instability. This trade war and energy standoff are quickly escalating into a global crisis. Historically, the US and Canada have enjoyed a relationship rooted in economic cooperation, but it is now teetering on the edge of becoming a battle for control over the energy sector. The US risks losing access to vital energy supplies, while Canada is strategically diversifying its markets and securing its economic future. This conflict extends beyond just two nations. It has far-reaching implications for global trade, energy markets, and international diplomacy. The outcome will shape how both countries navigate an increasingly interconnected and volatile global economy. The critical questions remain. How far will the US go to protect its energy dominance? And can Canada seize this moment to shift the balance of power in the global energy market? The world is watching closely. Like, subscribe, and press the bell icon for more updates. Thanks for watching.